Mario Gabelli, Chairman and CEO of GAMCO. Good to see you once again in Omaha.
Always a privilege to talk about my favorite subject, Berkshire Hathaway, and more importantly, stocks.
You have been a long-term holder of Berkshire Hathaway. It's now 50 years with Warren Buffett at the helm. Is there anything you would have liked him to do differently?
No, I don't think so. I think he's, how can you duplicate enormous success?
So the criticisms we hear when it comes to Warren Buffett as of late is that book values underperformed the S&P 500 the last few years. Why doesn't he pay a dividend? Why doesn't he invest in tech stocks? So these are arguments that people make in terms of what he could be do differently. Some stocks he's held haven't done so well over the past year. How do you answer those criticisms for him?
Well, I look at a snapshot of what's going on by reading the annual report, looking at the 2014 data, but I also take a look at the motion picture. And by looking at the motion picture, you go to times in the history of value investing, 1990, dull and boring, 2000, and if we were here, Rhonda, and the May of 2000, he had just written a report. His stock was old-fashioned, out of the classroom, out of the academic world, and didn't understand what was going on in .com. Stock was $40,000. He was advertising to buy it. So during this entire period, we, as for our clients, for our mutual funds, the Gabelli Asset Fund and the Equity Trust, which was our first open-end and closed-end funds, we just held it all through that. And so why pay a dividend when there's a tax leakage, when you can take that return and compound at a good rate of return? So to the degree you have scale, you've got 1.6 million shares at $100,000 a share, it's $320 billion market cap. Yes, your ship is going to move slowly, but it's moving surely. So yeah, people will criticize anything. If Warren Buffett was walking on water, they say he's walking on water because he can't swim.
So what do you think Warren Buffett should be buying?
Well, I'm not, these are companies that you can understand what will be the exit multiple if you ever had to sell it 5 or 7 years. In other words, what does well in an inflationary environment, what does okay in a deflationary environment, what generates cash flow so that he can reallocate that cash flow, and what price can he buy it at and what's reasonable. So in that context, things like he bought a car company, a retailer. We as a country sell 17 million cars, and there's 16,000 plus or minus dealers. So he wants to roll it up, but is he doing it because he wants to sell cars? Or is he going to make incremental money by financing people who buy cars? So one has to look through what he says and understand the fundamentals of the business. So buying car dealerships are easy. Buying a company like AutoNation is extraordinarily well run, would allow him to really get bigger quicker, because that's 100 million shares at a $70, $80 price he'd have to pay. It's $8 billion.
For your own portfolio these days, having trouble finding new value stocks to buy in this market?
Well, our ideal world is to find a company that's growing, that has proper use of cash flow, and to the degree that there are lots of companies that we constantly look at. Right now, it's earnings season, it's a first quarter, but it's also annual report time, so we go through chairman's letters, refresh ourselves, look at the analyst models, look at what we like, where's our core competency that we've compounded. So I would say you can't, when markets go up, you can't buy the quantity you want, because you have to buy it at a price, because we try to generate absolute returns for our clients. And so there's opportunities, but you have to be more selective.
Such as?
Well, we are buying a company in Nashville. We happen to like Christian contemporary music. We happen to like country and western. For example, Taylor Swift was country and western and migrated over to pop and so on. And there's a company down there that used to be called Gaylord. They now call it Ryman, after the Ryman Auditorium. The stock is $57. There's 50 million shares plus or minus. So you're talking about a $2.5 billion market cap. They have 4 hotels that are convention-sized REITs, real estate investment, equity investment trusts. And they have this business, a privately owned company internal to the REIT called Ryman, and we hope they spin that off. I think you can make a fairly good return over that over the next 3 or 4 years.
How about anything in media, given the big merger that did not happen recently? And
well,
that's an expertise of yours.
if I were giving advice, which I don't have to because he's really terrific at it, Brian Roberts has scale, understands scale and structure, was trying to scale up in terms of cable. And it's not video necessarily, but it is also broadband. Take that knowledge that he's created that was going to go to the benefit of the American consumer and take it and bring it to Europe. So he should buy cable assets in Europe, in Latin America, and I think he'll do that. So Comcast is an interesting stock. On the other side, Time Warner Cable is at $157. The sum of the parts, the fact that he offered to sell the company before for 100 in cash and 60 in paper, he should get a higher price. My hope is that before he does that, he buys Cablevision. And Cablevision is packaged up. They have 1.5 million subscribers in New York. Cablevision has 3 million. Take that 4.5 million, spin it off to the shareholders, and make corporate love. And then the content. You know, who owns content? Quality content. When you have smartphones, the consumer in India, the consumer in China, with 3 billion people with, I don't know, I'm going to cuff this number, billion smartphones, they're going to want content. Now, whether you want to watch cricket in India or whether you want to watch American basketball in China, the point is you want to watch something. And so those content companies are attractive in that regard. You know, we like Sony and we like Viacom and we like several others.
Mario Gabelli, thanks so much once again for your time.
Always a privilege. Thanks very much.